Hello, fellow Rebel Capitalists. Hope you're well. So, we have big news out today. I think we can safely conclude who is paying the tariffs. And the punchline here is it ain't the foreigners. Sorry, Trump. Sorry, Donald. Sorry, administration. The proof's in the pudding, as they say. So, let me go ahead and do a screen share. I've got to do this myself because Josh is he's swiping through Tinder or trying to look up who Ric Flair is, something like that. I don't know. But he's not here, so I've got to do my own screen share. All right, now let's go over to let's go over to the expectations first, because the news of the day right here, Friday, August 15th, we have retail sales. Now, what's the middle column here is the expectations. The column on the right is last month. And this is where they fill in the data that came out today. I don't know why Market Watch, you know what? Market Watch is doing the exact same thing Josh is. They're completely MIA. I don't know what's going on. Maybe they're swiping through Tinder as well. I, I don't know what's going on. It's the generation. It's these young kids nowadays. Anyway, fortunately, the BLS has the data we need. I guess this is the new version of the BLS. I don't know if that guy from the Heritage Foundation has started yet, but regardless, this is what we need to know right here. Import and export prices for last month. And again, this was released this morning, 8:30 a.m. Eastern time. And if we look at this shaded bar, we see the prices actually went up. They went up. So, and if you guys watched the video yesterday, I actually got it wrong on that chart. That's why I was a little confused, because the chart that I pulled up, which is this chart, I zoomed out a little bit. So let's do that and we'll zoom back in. This was the chart that Lynn Alden, my good friend, shared on Twitter. And I thought this was reflecting the price of the import plus the additional tax, the tariff. And so if this is flat, then you should assume that the foreigners are in fact paying the tariffs. But what I figured out after the video ended was this price does not reflect the tariffs. So if this price is staying the same, then you can safely conclude that the foreigners ain't paying the tariffs because they ain't dropping their price. Because see, if they were paying the tax, let's say there was a 10% tax, and let's say their widget was $100. Well, then if this included the tax, then they would drop their price of the widget down to 90. The tax would be, well, I guess it would be 9, but you guys get the math I'm trying to do here. And then what you would have is that import price stay the same. But what's happening here is these numbers do not include tariffs, like I said. And therefore, if the prices aren't going down, then this reflects the actual prices that the importers, the Chinese producers, the foreigners are actually charging for their widgets. So bottom line here is we go back to 2022 and the foreigners are charging the exact same price for their stuff today as they were in 2022. And by the way, if we fast forward to just this year, which I did earlier here, let's go to 1 year. Not 1 year, they don't do trailing 12 months, but we can just start at January. So starting at January, this price index was 129.8, and you can see right now 130.3. So if anything, it's the opposite. Foreigners have actually raised their prices. They haven't lowered them. So we can definitively say that the foreigners are not paying the tax. The foreigners are not paying the tariffs. So when you see a headline that the United States put in their coffers an extra $30 billion this month, and yay, because it's all coming out of the pocket of the Chinese, it ain't happening. And again, just look at the data. So then the question becomes, who is paying it? That's what we're going to get into. But let's go right back to the BLS report. Make sure I got the screen share working. Okay. And this is the table. Let me zoom in for you guys. That's a little too far. Okay. So I want to focus on the month over month. Now, the year over year is negative 0.2%, but that's really pretty much everything that preceded Trump. So, ironically, the importers were dropping their prices prior to the tariffs, but afterwards, they've actually, on net, when you look at each month of this year, the prices are higher. So, looking at imports right here. January, we were at 0. Then we had an increase. Now, starting in April, we had a 0.3% increase. May, flat. June, down 0.3. This month, up 0.3. Now, when you look at the 0.4, I believe that was, if you include, where are we here? This is non-fuel imports. That would be all imports. Okay. So the 0.3 is specifically non-fuel because, and I think that's the right way to look at it, because if you're including fuel prices, then it's all about energy prices. It isn't necessarily about what the importers are actually charging. So you want to strip that out for the sake of this video. And that's where we're at 0.3. But the bottom line is we are just slightly higher, but we're definitely not going lower for this 2025. Definitely not going lower. So, okay, we get the punchline here. Now let's go over to, we did the Wall Street Journal article. So this is what we discussed yesterday, just as anecdotal evidence. But I think I just wanted to show this headline real quick here for those of you who didn't watch the video yesterday. Even with U.S. plants, in other words, even though they're manufacturing these tractors in the United States, Caterpillar is still paying the tariffs, and a lot of them, by the way. In fact, they're expecting the tariffs to increase or to cost them 1.5 billion this year. Now, all of that I don't think is a direct result of actually paying the tax, but this is when you consider all factors. Now let's go over to let's see here. I had this up. It was Market Watch. Right here, CNBC. So headline here, guys, is CNBC, Trump says tariffs haven't caused inflation. Economists think they will soon. Usually, I don't really agree with the economists. I don't really agree with the politicians either. But in this case, what the banks are saying, it makes sense. It makes sense because you've only got 3 levers to pull here. Number 1, the foreigners are paying the taxes, tariffs. Number 2, the consumers are paying the taxes. And as we can see in the CPI data, it's not going up a lot. So maybe the consumers are paying some of the tariffs, but so far they're not paying the bulk of them. They're not paying 100% of them. And we know that the foreigners probably aren't paying any of them. Now, in aggregate total is what I'm referring to. So wait a minute here. If the foreigners aren't paying the taxes, the consumers aren't paying the taxes, somebody is, because the administration is collecting whatever it is, $30 billion a month in tariffs. So where is this coming from? It goes back to Caterpillar, and this is what the big banks are talking about right now. And this is their argument for why we will eventually see, I don't want to call it inflation. It is higher prices, for sure. But in my view, this will not lead to an acceleration of prices. It will simply lead to a price adjustment higher, which, for the consumer, what's the difference, right? You're still paying higher prices, however you define it or whatever you want to call it. But when we're looking at this from a macro standpoint, we definitely need to distinguish between the two, an acceleration or just an adjustment higher. And this is what the Fed should be looking at as well. So you guys, I'm sure, heard the news that Trump came out, and typical Trump style here, he was very critical of the CEO of Goldman, because Goldman came out with a report saying that in the fall, we'll most likely see some consumer prices go up as a result of tariffs. And Trump, says he's an idiot, just normal Trump stuff. And so Goldman came back, or at least the CEO, and I don't think he responded to Trump, but in an interview, he talked about the rationale and why their economists came to this conclusion. And for me, based on the data that we're seeing right now, it actually does make sense. Here's a quote. If the most recent tariffs, like the April tariffs, follow the same pattern we have seen with those earliest February tariffs, then eventually by fall, we estimate consumers would bear about 2/3 of the cost. Again, that makes sense to me, because the punchline here, or one of the main takeaways, is if the foreigners are not paying it, which they're not, if the consumers aren't paying it, which they're definitely not paying 100%, then the only other lever you can pull is the importer, the American companies that are importing these goods from abroad. They're the ones that are paying the tariff. They're the ones that are eating costs. This is eating away at their margin. And that importer could be a retailer like Walmart. So they're basically absorbing the cost. They're decreasing their margin, which is exactly what Caterpillar is doing. But what Goldman Sachs, their hypothesis is corporations will only be willing to, American corporations will only be willing to do this for so long. Like, they're probably doing it right now because the demand is very, very low from the consumers. So they think if they increase prices, then there's no way the consumer is going to be able to absorb that. And it's going to be too big of a hit on aggregate demand. That could be one reason. Another reason could be they just, they're like, okay, well, we've got these tariffs today, but what are they going to be tomorrow? And what are they going to be in 6 months? And who knows? So there is a reasonable probability that we just won't have tariffs in 3 months, or they'll be a lot lower. And if that's the case, then we don't want to raise our prices now, because if our competitors don't, if they're willing to absorb the margin, then they have a competitive advantage, and we don't want to lose market share to them. I think that's probably what's going on here. But Goldman's point, and they go on to, I think they quote UBS. They do. Senior economist Brian Rose, UBS. I think their point is the retailers, or the American importers, they don't want to, they're not going to absorb this forever. And therefore, if the tariffs stay high, then they are going to go ahead and pass that through to the consumer, which is why they're coming in at like two-thirds of the cost. So senior economist Brian Rose wrote that the downward trend in core inflation has been broken as tariffs start to feed through into retail prices. Okay. I mean, I guess that's an argument. I don't know that you could say that 100%, though. Maybe there's some prices that are going up a little bit because of the tariffs, but it ain't 30 billion a month, that's for sure. And so I think it's like a 90-10 split, maybe 90% coming from the American companies who are importing the goods or selling them, like Walmart, to the consumer, or it's a small portion of the consumer. But I think as we go into the fall, there's going to be a bigger and bigger percentage being paid by the consumer. But that's not necessarily an acceleration of prices. It's more so a price adjustment. Let's see, what do they conclude? They conclude tariffs could add 1 to 1.5% to inflation, some of which has already occurred. I don't know about that. I think they're probably talking about headline CPI. So right now we're at 2.7. So they're saying by the fall it could go up to 3.7. I don't know about that. I do not agree with. I could see it going up maybe 50 basis points or something like that. But why is that? Because at a certain point you're destroying demand for discretionary spending, or you're destroying demand for stuff that is produced, services in the United States that aren't tariffed, that don't have a tariff, right? So as an example, if the wages aren't going up, I talk about this all the time. You can raise prices over here, but that doesn't necessarily mean that the basket of goods, the entire basket of goods and services, prices increase, because although they might go up over here, then they're likely going to go down over here because the incomes aren't going up at a rate that can handle the increase. And if this is stuff they need, they have to take away from the stuff they want, and then unemployment rate goes up, and then that impacts the demand. Very similar to what we saw in 2008. We talked about that on yesterday's video. They say, of course, the consensus view did not mean predictions will come true. Recall how economists were all but certain U.S. recession would happen in 2023, only for the economy to grow. Yeah, yeah. I mean, there you get back to the data, right? I mean, let's remember in 2022, the first two quarters, we had a technical recession, and the NBER said, "Oh, yeah, that's fake news because we didn't have the employment rate go up." But then we now know that the employment numbers, the non-farm payrolls, were I don't even know what you want to call them. You can't call them bad. That's a dramatic understatement. I mean, when you revise down by 800 and what 18,000 in 2024, and you have that same pattern. Now, I don't know that it's political because they did the exact same thing under Biden that they're doing under Trump, meaning they juice the headline number and then they just revise down, afterwards. Just hopefully the market won't pay attention to this. We'll just sweep it under the rug. So, if we were getting accurate data, what would it have been in 2023? And let's just say that unemployment or the employment picture might not have been as rosy as we were led to believe. Would the NBER would have come out, or would they have come out and then revised down the GDP numbers? I don't know. This is the problem. This is the guessing game now. And I think what you have to do as a astute investor is you got to start looking at things outside of the government data. And this really sucks because in all of the research I've done on how to time a recession or an economic contraction, a lot of it revolves around the labor market. And unfortunately, the numbers that have moved the markets in the past and have prompted the NBER to come out and actually admit that we're in an economic contraction, those numbers are all provided by the government. So what do you do? I think you can look at things like the price of oil. So actually, let's do that. And by the way, I've got another shirt on here, guys. This is a shirt that you should definitely highlight right here, baby. If freedom of speech is taken away, then dumb and silent we may be led. George Washington. And that is very difficult to read backwards, just so you know. But this is a shirt we should all have in the closet. That's for sure, baby. It's all about freedom of speech at the end of the day. All right, getting back to the video here and the topic at hand. So let's go over to CNBC. Let's look at the price of oil, guys, because this is, I think, now probably a better indicator than the BLS data, especially moving forward. I mean, look, should the gal have been fired? Absolutely. Absolutely. But that doesn't mean that the person coming in isn't going to be a yes man. And just because, should she have been fired? Absolutely. But I don't know that it was because of political reasons, because again, she was doing the exact same thing in 2024. I think it was just out of sheer incompetence in the method. If you're having to revise that significantly, either you're stupid or your method's bad. And in which case, if you're not changing the method, then you are incompetent by definition. So, but regardless, the new person, the guy that's coming in from the Heritage Foundation, what he has proposed, if you haven't watched the news, what he's proposed is just not reporting the numbers. He just came out and said, yeah, those employment numbers, we really don't need that. Let's just go ahead and report them quarterly. And then you got to roll your eyes and just be like, oh, okay, here we go. So now we're going to play this game. So it doesn't matter, it doesn't matter if it's incompetence or political or whatever. The bottom line is these numbers are going to be very, very difficult to trust moving forward. So let's go back to the price of oil, guys. And we see especially this trend over, call it once Russia invaded Ukraine, we had this big spike. And then, everyone was saying oil is going to go to 4,000 or whatever. And of course, everyone's on one side of the boat, does the opposite, goes down. And the trend is definitely lower here. Definitely lower. And it's not like this is a result of massive supply. This is more a demand side story. So now I know that this really is about the global economy. And can the United States avoid a recession if the global economy itself is slowing down? Maybe. I mean, that's definitely an argument, a debate that we could have. But if you see oil, the price going down further and further and further, especially when they have all these supply cuts, when I mean OPEC, this is just really telling you that the economy ain't that great. Whether it's a massive recession or crisis, I'm not saying that, but the global economy is not doing well. And you see that in China. I mean, we see that all over the place. We see that with all these central banks lowering interest rates. They're in the cycle. They can pause, but eventually, it all goes one direction. When they start, they don't stop. And I think it's going to be the exact same thing with the Federal Reserve, and we're seeing that in the price of oil. The other one I talk about all the time is the restaurant index. Now let's see if that has changed. I doubt that it has. And this is the restaurant performance index, guys. Yeah, we're still kind of just right teetering on the edge. Not good, not great. So they say right here that values over 100 expansion, values under 100 contraction. So if you see oil start to go down, into the 50s, and then you see this start to go down into the contraction, let's say, zone, and then you combine that with, let's just say, interest rates are going down, this is going to be a pretty good indicator, especially if you come out with a negative non-farm payroll when we know that there's a yes man in the BLS. But that assumes, of course, they're going to give us the non-farm payrolls moving forward, which they might not. So let's look at interest rates. And yesterday, when we had that PPI number that just blew out expectations, as you would imagine, interest rates did go up, but not a ton. Well, let's look at a 6-month chart. So, I mean, just back in June, we were at 4.6. We're at 4.33 on the 10-year right now. So trend here definitely lower. And we did get a blip up, but in the grand scheme of things, I don't know it's that significant. It seems to me like the market still wants to go lower as far as interest rates. And then let's look at what's happening with the all-important 2-year. Up today, 2 basis points, but let's look at that same chart. And we can see this is just last 6 months. I mean, it is way down, way down. And a lot of people claim that, foreigners aren't buying our treasuries. There's no demand for treasuries, where, interest rates are skyrocketing. You hear this all the time on social media. And I just wonder if those people ever actually look at a chart. It seems like it's like this post-reality world that I've been talking about lately. Like the reality and the numbers don't matter. It's just the narrative is interest rates are skyrocketing, and that's all we need is the narrative. We don't even have to look at a chart. Look at this. If you look at the 2-year Treasury yield, this is the performance over the last year. So we've got 5-day, 1 month, 3 month, year to date, and 1 year. So how do you look at this and tell me interest rates are skyrocketing. And and there's no demand for treasuries. Huh? And keep in mind, this is showing you the yield. This is showing you the interest rate, which is the inverse of the price. So year to date, the 2-year treasury is down, as far as the yield. The interest rate is down 48 basis points year to date. Even with the April blow up and foreigners dumping treasuries and dumping the dollar and all this stuff, we're down almost 50 basis points. So I think whenever you hear these narratives, you always have to reconcile with the actual data, the underlying data, to determine actually what is reality, unless you don't care about reality. Maybe you're one of those people that doesn't care. All you care about is the narrative. There's a lot of those people out there, that's for sure. So those are the things I would look at. Those are the things I would focus on. And obviously, over the next couple months, we really want to pay attention to the import prices to see if those are continuing to go up, flat, or if those go down. Again, if they go down, then sure, we can honestly say that the foreigners are paying some of the tax or the tariff, but right now, it ain't happening. I don't care what the narrative is with the administration, with the mainstream media, with social media. The foreigners are not paying the tariffs, and the consumers really aren't paying the tariff. It's the guys, gals in the middle. It's the American companies that are importing those goods, or like Walmart, selling them to retailers directly to the consumer. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, and freedom of speech. See you in the next video.